If you die in these states, your spouse is going to pay way too much in tax. PVC trumpet. Hear ye, hear ye. All eyes on me. All eyes on me. So I've done videos on this topic a couple times, and not even that long ago actually. But I just got done reading in a letter, an article, I guess an article, paper, in the Michigan State Law Review. I'm so smart. You read the Michigan State Law Review? Well, if it's something of interest, yeah, absolutely. I used to subscribe to Trust in Estates magazines, my friends. In fact, I think I've shared this with you. I went to a lunch with a guy who was a bigwig at Trust in Estates magazines back in his day, and he used to work with like a guy, a confidant of Warren Buffett. This guy, I'll never forget. His old retired Marine, did very well in legal practice, and I'll never forget sitting over his. We're sitting at lunch in Oyster Bay, New York, in Long Island, and just overlooking whatever the river is, the water. I don't know what the hell it is. Long Island Sound. He said, that's Billy Joel's house. Billy Joel was a local boy gone good. I said, yeah, he did, man. Mary Christie Brinkley. Yes, sir. Yes, sir. But anyway, a good guy. And I'll never forget, he took me out to lunch, and we were just talking about estate planning, and so it was pretty interesting. Anyway, long story short, I used to be pretty active in estate planning, and I'm not a practitioner. I'm not a lawyer. Certainly don't want to claim to be one. Probably should have been a tax lawyer in my previous career, but I like what I do now. I've always been interested in tax codes because I'm probably of a different Abrahamic religion, if you know what I'm saying. How much I enjoy finding stuff in the tax code that many people aren't aware of. There are other people that are, but I freaking love it, dude. I probably was a different Abrahamic religion, if you know what I'm saying. How dare you? But dude, it's called being funny. All right. So in this case, we got this article or paper from Daniel Durst. And it's titled Geographic Income Tax Marriage Equality. And I'm thinking, 57 flavors. I thought we've already done all this, but it has nothing to do with 57 flavors. All right, so and this is 2022 Michigan State Law Review from this guy, Daniel Durst. Surviving spouses in community property states enjoy a significant but unintended income tax advantage over surviving spouses in other states. The advantage is known as a double basis step-up, which generally eliminates capital gains for surviving spouses in community property states. Taxpayer strategies to obtain a double basis step-up exacerbate wealth inequality, as they are most likely to be implemented by individuals with not only the motive but the know-how to obtain sophisticated tax advice. So I don't think you need to have that sophisticated tax advice here. And you've got to talk to tax professionals in this regard. Your attorney most likely is where to start. Certainly a CPA. But I'm going to kind of go over some examples how this works, because it's a big flipping deal, man. It's a big deal. And the fact, if you're in a wealth management program by some big wealth management firm, and you're in a common law state, and you have assets outside of IRAs, or you have a significant cost basis, a lower cost basis on a home, or a second home or something like that, you need to be looking at this stuff, dude. That's all there is to it. And it's because it's fundamental to your taxes. Do you want Bo Jiden to get your money so he can send to Israel and Ukraine? Or whoever else, or do you want your spouse to get it so she can give it, or he can give it to your daughters and your sons and all that? So let's dive a little bit more into this. So as you see, I got a ton of highlights here, and it's very interesting I find this fascinating. I'm not gonna read it all to you because you'll get bored and you'll never come back to see my videos again. But we are gonna go down to where I got the yellow highlights here, and I'll print this off for my future reference here because I like to print this off, and I'll leave you a link in the show notes as well. Let's see, right here. The horizontal inequity created by the double step-up rule between common law and community property surviving spouses is readily apparent. A community property surviving spouse generally can sell his or her property after the death of the first spouse without realizing any capital gain. All right, are you hearing that? A community property surviving spouse can generally sell the asset after the death of the first spouse without realizing any capital gain, while a common law spouse cannot, a surviving spouse cannot. Thus, similarly situated surviving spouses can face widely different results depending on the magnitude of the capital gain built into the surviving spouse's assets. And we're going to give an example here, which I'll later relate on the whiteboard here. Did I say white? How dare I? The inequity of the double step-up rule can be illustrated with an extreme example, a simple example. Assume there are common law spouses, each owning assets of $1 million schmackaroonies and a basis of $500,000. All right. So you got Josh and Charlotte. We each got $1 million. Josh has $1 million. Charlotte's got $1 million, and we each have a cost basis of $500,000. If one of this is in a common law state. If one of the spouses dies, the decedent's assets will receive a step-up basis to $1 million. But the surviving spouse's assets will retain the basis of 1.5. And again, we're going to get to this here in just a second. If the surviving spouse were to sell the surviving spouse's assets for $1 million, she would realize a capital gain of $500,000. All right. Again, if the surviving spouse, Charlotte, were to sell Charlotte's assets for $1 million, she would have to pay capital gain tax on $500,000. All right. Now, that's just a fact. She would get my asset, my $1 million I transferred over to her, she would get that with 100% step up because that's how step up basis works. So she could sell mine for $1 million tax free, capital gain tax free. All right. If she were to sell also her own, she wouldn't get 100% step up. There is no step up because she already owned it. She would sell her property for $1 million. She'd have to pay tax on $500,000. I'll visualize this here in just a second. It is confusing. If you're visual like me, it helps to actually see the whiteboard. Contrast that with community property spouses owning the same $2 million of assets together with $1 million of combined basis, but as community property instead. If one of the spouse dies, each spouse's half of the community property receives step-up basis to the full $2 million schmackaroonies. Afterward, the surviving spouse could sell the whole kit and caboodle without realizing any capital gain. A more extreme example, though hardly impossible, evidences the inequity further. Suppose in the preceding example that between the common law spouses, the first spouse, Josh, owned no assets, while the second spouse, Charlotte, owned $2 million worth of cost basis of $1 million schmackaroonies. So I got nothing. Charlotte owns $2 million. If the first spouse dies, me, all right, there are no assets for Charlotte to get a step up in. The surviving spouse assets Charlotte's would retain her initial $1 million cost basis. If she were to sell those assets, she'd pay capital gains on the full $1 million. The results of the community property surviving spouse, however, remain unchanged from the prior example. That is, community property surviving spouse still would receive no capital gain on a similar sale after the first spouse death. That's huge. We're talking any kind of non-IRA asset here. Anything that's got a cost basis. A potential capital gain. Remember, IRAs, 401ks, there's no capital gain. It's all ordinary income. There's no capital gain in an IRA, 401k, 403b, TSP. Your house has a capital gain. I get it. You get $250,000 of exemption if you're single, $500,000 if you're married. I get that, but there's more to it than that. Because what if you bought a house in 1993 in San Jose? Like I've had clients for $300,000 and now it's worth $2 million. All right, let's keep going. The inefficiency created by the double step-up rule is evidenced by states like Alaska, Tennessee, South Dakota, Kentucky, and Florida tinkering with long-standing fundamental marital property laws for the purpose of attaining the federal income tax edge of the double step-up. So we got community property states identified, California, mostly the states out west, California, Washington, things of that nature. But then you have also other states here in the East Coast, Tennessee, Kentucky, and Florida. I'm not sure about South Dakota. I wouldn't consider that East Coast. But anyway, you got other states that are saying we're not community property specifically, but we're going to have community property opportunity for community property assets to be transferred at death, even though we're not a community property state. It's very interesting. So we know they got, I think it's like, I can't remember how many community property states are. I just don't remember. 13, I think, but don't hold that account. It might be 8. I can't remember. But there's like a certain amount of community property states, mostly out west. Texas, California come to mind. Washington, I think. Utah, I think. There's a bunch of states out west that are community property. And then you got Alaska, Florida, Tennessee, South Dakota, and Kentucky that all have laws in their books now that are trying to recognize the idea for community property within their states, which are still common law. Pretty interesting stuff, all right? So that's pretty cool. Tax professionals in common law states must understand community property laws and how to take advantage of them if possible so they can counsel their migratory clients effectively. In fact, it's very interesting. If we look at Alaska, I'm not sure I had it in here. Like, for instance, here is pretty interesting. I'll come back to Alaska in here in just a second. In states as diverse as Utah, Ohio, and New Hampshire, in encouraging New Hampshire's legislature to adopt an elective community property system, Professor Calvin Massey wrote that of the several advantages offered by community property, the most important advantage is the federal estate tax treatment of community property upon the death of a spouse. 100%, man. So we got right here, 2020, Kentucky became the 4th state to adopt an elective community property system. The language of Kentucky mimics that of Tennessee's for a few years previously. Most recently in Florida in 2021 did the same. All right, but check this out what Alaska did. It's crazy. Right here, Alaska was nuts. In 1998, Alaska did something that no state had ventured to do since the Supreme Court's initial ruling in the IRS Commissioner versus Harmon. They adopted an elective community property system. Alaska spouses could create community property by entering into a community property agreement or creating a community property trust. Check this out. Alaska's law had gone still one step further than ever been done before. Alaska also offered non-residents the opportunity to create community property trusts. Non-resident couples could simply create a trust invoking the Alaska community property law and naming at least one trustee that is a state of Alaska domicile, or an Alaska bank or trust company. The express objective of the new law is to give non-residents who establish a community property trust the ability to take advantage of the double step-up basis. Now, that's probably beyond the scope of most of my folks I work with on this YouTube channel, but that's how opportunistic the law is when it comes to this stuff. It's crazy. And not to know this is ignorance of the law is no excuse. So this guy, I thought it was a chick who wrote this because I was like, So he wants us really to create such a geographic equality sooner rather than later for at least 2 reasons. First, the double step up is founded on outdated and chauvinistic assumptions regarding property ownership that are just not tolerable today. Not tolerable today. How dare you? Don't you know? Oh my goodness. I can't take it right here. It's so stupid. Well, check this out. Right here. Furthermore, the assumptions made in 1948 regarding male versus female property ownership and life expectancy have no applicability to same-sex marriages. Relying on stereotypes from the past is no way to create equality today. What a freaking maroon. Oh, gosh. All right, so we're going to use an example here. And if I remember, I'll link to that paper. All right, so we got common law state right here, CL, common law, and we got community property state. So I'm in Georgia, common law state. You can't really see that. But we got husband and wife, all right? That's me, your old buddy Josh, and that's my better half, Charlotte, the beautiful one. We got $1 million of mutual fund assets, $1 million in mutual funds. We have a cost basis of $100,000, all right? So we got $1 million is our current market value, cost basis of $100,000, all right? So we're joint tenants with rights of survivorship, essentially. So I own half. The cost basis, I own half of this $1 million. That's $500,000. My cost basis is half of this. So $50,000 is my cost basis. Charlotte's, same thing. She owns half of this $1 million, $500,000. She owns half half the cost basis for $50,000. I kicked the bucket because of long COVID. Long COVID. I kicked the bucket. Now, I have $500,000 is my value on this. I also have a $50,000 cost basis. However, my cost basis is $500,000 upon death. That's what that is. So my cost basis is $500,000 because it steps up as the date of death to my fair market value at death. Date of death, all right? So I add that $500,000 to Charlotte's $50,000 cost basis. So if Charlotte were to sell this asset at my date of death, because she's going to go with the pool boy to freaking Mexico, as probably she should have a $550,000 cost basis on $1 million property, which means she'd have to pay capital gain tax on $450,000 schmackaroonies. And that's if we own it jointly. What if she owned the entire thing in her name and I don't own anything in my name because of second marriage, or maybe just Charlotte's a better investor than me or something like that, and then I died? I mean, there's no cost basis. Like a $100,000 cost basis on $1 million property, she'd have to pay tax on capital gain tax on $900,000 schmackaroonies. Again, we have a cost basis of 100. We got $1 million fair market value. We're joint tenants. 500 goes to me, 500 goes to her. 50,000 goes to me, 50,000 goes to her of the cost basis. I die. My cost basis is stepped up to the fair market value date of death. And this fair market value date of death is $1 million. My cost basis is half of that. So I add that to that, and I get this right. I add that to that, so I add my $500,000 to her cost basis. We get that right there. That makes sense. Yes, it does. So she has a capital gain tax of capital gain. We got to pay taxes on $450,000 capital gain. Community property, exact same scenario. Exact same scenario. I die from. We'll just say, I was suffering from DDT because the government used to fill the neighborhoods with wonderful DDT for you and me. And no wonder why everyone has smallpox, not smallpox, but polio. But don't blame DDT and just make a martyr out of Jonas Salk. People don't know their vaccine history. They just don't. It's actually pretty sad. It's pretty sad. They don't understand the vaccine history. How dare you not challenge? How dare you? You want to be an iron lung? If it wasn't for Jonas Salk, and I forgot the guy who replaced him because Jonas Salk has a lot of disabilities when the people took that vax. Forgot who the guy who was that came up a couple years later. But let's just put it this way. What you've been told ain't the truth. That's just a fact. Smallpox too. Oh my goodness. We have smallpox eradication. Maybe we've had more cleanliness, better hygiene. That could have worked. Oh yeah, it did. Anyway, so we go back here. You're such a conspiracy theorist. Yeah, and if you're not by now, I don't know what to tell you. This probably ain't the channel for you. $100,000 cost basis, $1 million fair market value. I kicked the bucket because of long COVID. My cost basis is $500,000. My initial cost basis steps up to my cost basis. And so does the same thing with old Charlotte there, even though she's still alive. So she has her cost basis is stepped up to $500,000. My cost basis is stepped up to $500,000. So when Charlotte goes down to sell the account and go live in Mexico with a pool boy, she has $1 million cost basis and $1 million fair market value and pays no capital gain tax on that whatsoever. Now the argument would be, well, there's an estate tax. Well, the estate tax is not an issue at this stage, just not. They'll say, well, they're getting you, maybe not with the capital gain, but they're getting you with an estate tax. I mean, again, unless you're uber-duper wealthy, that's not an issue, just not. So I'm not in the least worried about that. Now, it could be again in the future, but as we sit here right now, it's not. So the point is, how do you title something in community property? I don't know. I don't know how to do that. I don't know. You'd have to talk to a tax professional for sure. Estate planning attorney, tax professional, CPA. Someone say, hey, how do I do this? How can I take advantage of community property? And by the way, if you move from Texas to New Jersey like we did and now down to Georgia, you can retain your community property titling on your assets. All right. Again, how does that work? I don't know. Be advisable to talk to an estate planning attorney or a CPA or someone knows this stuff. You move from a community property state to a common law state, you can absolutely retain the titling of your assets as community property over common law. Now, again, that's up to you to figure that out. I can't tell you on that. I'm not an attorney. I'm not licensed to practice law. Probably should have been. Probably would have kicked ass and took names and made all kinds of that money. Because, I'm obviously was supposed to be in a different Abrahamic religion. I could be sitting there right now with freaking, I could buy the Atlanta Hawks. Did you hear about the Atlanta Hawks' son? He's literally a big commie. The Atlanta Hawks owner's son is a big commie who's funding all these Palestinian thugs that are going out there and harassing Jews. It's freaking crazy, dude. It's just some rich commie. The left is so evil. Because they're not even left. They're so far left, they're absolutely fascists. There's all there is to it. They're Nazi fascists. But they'll say, punch a fascist. I'm like, well, you can punch yourself there, guy. All right. Love your thoughts. We'll see you. Don't forget to subscribe to my email list down below. If these videos help you, as they should, because I'm kicking ass and taking names, where else are you going to get this kind of info from just a simple financial planner in his t-shirt and underwear? You can sign up, click on my Amazon link down there. Any stuff you buy on Amazon, if you click on my link first, it credits me as a commission. Just use the link, dude. Use the link. I tell you, just click it. All right, now I'm going to buy a bunch of stuff. I get paid. I don't know, it's not a huge amount of money, but don't you want to feed me? I need some food. All right, we'll see you. God bless.